Welcome to Bar Chart's weekly series of webinars designed to help you, the investor trader, better understand a variety of trading ideas and concepts, as well as the pages and tools that Bar Chart provides to help you to make a more informed investment decision. Today's subject, long call butterflies. The long call butterfly is a limited risk, neutral price bias, limited profit potential option strategy. The trade is a spread combination consisting of a bull call spread and a bear call spread, where the trade benefits from falling volatility, time decay, and little price movement. Hello, everyone. My name is John Rowland, Bar Chart's head of trading education, and with me today is my partner and our moderator, Bar Chart's project director, Gene Baker. Hello, Gene.
Good afternoon, John. How are you?
I'm doing well, and nice day in Chicago today, or not?
It's a little gray, a little windy, but boy, the temperature, you can't be complaining about that. It's nice and balmy out there.
Nice, nice. So, Gene, I think you once told me you live close to a park. Did you ever go in the park and run around chasing butterflies?
Chasing butterflies. No, John. No, I have not. Nope. How about you? Do you chase butterflies?
Yeah, well, we have a very large butterfly bush in our backyard that attracts many different varieties of butterflies, monarchs and tiger swallows, and this big black and blue butterfly, and these little teeny, small, delicate white and yellow butterflies. So when my daughters were young, during the summertime, they used to run around and chasing butterflies. And they would say things to me like, it's hard to catch them, Daddy. And I would reply to them, well, where do the butterflies want to be? And they would say, at the bush. But even then, the flights of the butterflies and where they would land would be random and erratic. Well, the butterfly strategy, like my daughters chasing butterflies in the backyard, are both trying to predict where the butterfly is going to land. Difficult to say, at least. So my job today is less about helping you predict where price is going to land, but where you can find that butterfly bush. Okay, so let's get started. There's my little picture. Hello, everybody. All right, a little disclaimer. Today's session is for educational purposes only. Decisions to buy, sell, or hold, or trade in securities, commodities, and options involves risks. And options trading is not for everyone. We at Bar Chart recommend that you seek the advice of a qualified financial professional. See whether options trading is suitable for you in light of your financial conditions. And under no circumstances shall we be liable for any loss or damages you or anyone else incurs as a result of any trading or investment activity that you or anyone else engages in based on information or material that you receive through barchart.com and barchart services. Okay. So the long call butterfly strategy, as I mentioned before, is a combination of this bull call spread and a bear call spread, where the trader looks to take advantage of a drop in volatility, time decay, and little or no movement in the underlying security. Now it has 4 calls, 2 short calls at the same strike price, 1 long call at a strike above the short calls, and 1 long call at a strike below the short calls. And all calls have the same expiration date. So essentially what we have here is a short straddle with long call protection above and below our short strike. Our maximum gain and maximum loss, well, our maximum gain would be if the underlying stock or security's price lands right on the middle strike, we're going to call that our body, at expiration. In other words, our butterfly lands on the exact flower we predicted at the precise time of that prediction. If at expiration price lands on the short strike, then our out of the money call above the market would expire worthless. Our short strikes would expire worthless, and our in the money call would have value, and that minus the original cost or the debt that we're going to put up to enter this trade would be our maximum gain. If price closes below all options, then all calls would expire worthless, and our loss would be limited to our initial investment, initial cost. If prices cross above or settles above all of our options, then all the options would be in the money, and they would offset each other. And again, only the initial debit would be our loss. So break even and profit loss. So our break even is basically if prices at expiration of the underlying stock is above the lower strike or below the upper strike by the amount of the premium we paid to initiate the position. In other words, the downside break even would be the lower strike plus our debit, and the upside break even would be the higher strike minus the debit. And the potential profit loss are both very limited. As a trader, we're going to buy the butterfly and we're going to pay a premium somewhere between the distance between either wing and the body. We're going to call this our wing differential. And the profits will occur if the value of the butterfly moves from our break-even value towards the maximum gain as we approach expiration. Now, in general, what we want to look for is the smallest amount of risk as possible in terms of our rewards. Typically, we will find greater opportunities in higher volatility markets or high price stocks. They're having their strike differentials about 10 to 20 points. Now, this is just going to be based on each individual trader and their risk reward tolerances. But regardless of the strike differential that we choose, we always want to have our risk to be less than our profit. All right, our Greeks. Well, first of all, delta. We want to initiate this position with a net delta of 0. The closer we get to 0, the more neutral of a bias we have in this trade. Now, the short calls that we're going to establish the body do not have to be at the money. We can place that price at a price we believe will be at expiration. Now, if I create a body that is below current price, I'm going to have a slightly bearish bias. If I create a body that's above current price, then I'm going to have a slightly bullish bias. My change in volatility, my vega, is slightly negative. If price blows right through my wings, then the trade washes out. But if it vibrates back and forth between my wings, then volatility might stay the same or it might actually even increase. But depending on the time left to expiration, theta could neutralize this negative effect of vega. And that brings us to theta. Theta is time decay, and every day prices between our wings increases the value of our butterfly, all things being equal. And initially, gamma will be less as we enter the trade, and as we get closer to expiration or we sit on the strike, then we have a negative gamma exposure. Assignment and expiration risk. So assignment risk can happen at any time if price is above our underlying stock is above our short strike price, our body. If price is above our body, we could get assignment. In the event of a potential X dividend, also, we could get an assignment risk. Now, because maximum profit occurs at expiration, and if the stock is trading right on the body of the butterfly, this strategy has an extremely high expiration risk. So it becomes virtually impossible to know which one or none or both of those short calls could be exercised. So the best practice would be for the trader to exit the trade before expiration date. Now that could mean that we hold the trade during the day of expiration, but we're not going to hold it through expiration. Because we're always going to be thinking about exiting a profitable trade before expiration to avoid this expiration risk. Now, I do use a rule that I'll pass on to you guys. I believe in the rule called the 50% rule. If I'm on the body with a couple of days left in this trade, a couple of days to expiration, and I'm up 50% of my maximum profit, well, cha-ching, I'm going to ring the register and run. I'm going to get out of this trade. I'm going to put my money to work for something. I'm not going to risk that volatility that could happen on the last trading day. Okay, so let's do this. Oops, sorry. There we go. All right, so I'm in bar chart right now, and I'm under the options section. There we are, our butterfly strategies in the long call. And I'm going to let that load up. While I'm letting that load up, I'm just going to come over here and move this over so I have a lot bigger screen for presentation purposes. So as we walk through the columns, first I want to just point out to you that this page is ranked by the probability of break even. All right. First, we have our symbol. Now, one of the nice things about the symbol is if I go to the plus sign right here and I push on that plus sign, what it does is it pops up a chart for me. And what's just nice about this is we can start doing that visualization. When we start doing some technical analysis, I can look at this chart and say, is this a chart that looks like a stock price that is going sideways or going no place fast? And what I kind of want to look for is price bouncing between a most recent swing high or swing low, or a significant, pivot high or pivot low. So I'm going to look for that type of chart pattern. But also what's nice about this pop-up is I can go to the technical section and look at some technical analysis as well. Now, we'll talk about some of these things in our session today. For instance, the 20-day historical volatility. The 20-day historical volatility. But also we can start thinking about things like our stochastics and our RSIs, other technical analysis. We probably want to look for our stochastics and our RSIs close to that 50 value, or at least decelerating towards 50 from below to 50 or from above to 50. All right, what is my last trading price of this particular security? What is our maximum profit, our profit percentage, and our max loss? Again, here we want to pay attention to, we want to pay as little as possible in terms of maximum loss, and we want to try to get more of a reward. Now, again, in general, the higher the chance of price sitting at the body, the higher the price we're going to pay. So this is a give and take we need to be aware of, right? The more probability I want of a successful trade, the more I'm going to have to pay. If I'm willing to pay less, then that might lower the probability, but that also might increase my reward. But at least what I want to look for is that my profit is greater than my loss. So one of the things we're going to look at is when we start picking candidates, Well, maybe we'll look at a threshold of 100% maxed profit. What we're really doing here is we're looking at an equal value of loss to reward, or a one-to-one relationship. All right. So then we have our BE plus and our BE negative. That's our break-even upper and lower wings, plus or minus that debit or that net loss. Then we have our probability, our expiration date, and then our strike 1, 2, 3, and the corresponding asks or bids based on if we're going to be buying or selling them. So leg 1 is our long call wing. Leg 2 is our short call body. And leg 3 is our long call wing above price. And notice that they are equally distanced. So the next thing I can do in my screener is I can go into my views and look at dividends and earnings. And I can see if dividends or earnings will impact this trade during the life of our butterfly. So earnings would be a nice catalyst for us. The effect of earnings tends to increase volatility. Increased volatility also increases our premiums. So depending on our risk tolerance, we might embrace earnings in order to capture greater premiums. But we also want to be aware of ex-dividend dates, because that also increases that probability of us being assigned from our short call. So earnings good, dividends bad. Now we also have another filter, which is called the filter view. And this will contain the variables of inputs or filters that are in the default of our screener. Or this is where we could add, by us, filters to help us narrow down candidates and fields. So before we look at making adjustments to our screener today, or adding some additional filters, let me show you a quick trader's trick in deciphering, picking some maybe good strike candidates. And this is really about a short-term butterfly, let's say less than a week to expiration. What we want to do is we want to look at the open interest of the wings versus the body. And again, in general, we want the body to have the largest open interest over the wings. Now, what happens many times as we near expiration, market makers try to pin down price at the strike that has the largest open interest. And this will make those options become worthless. So for us, we want to look for the largest open interest on leg number 2, the body. Now, this is not a deal breaker, right? It's just something for you to look for when you start picking out potential candidates. All right, so today, right now, I just loaded this up. We've got 994 potential opportunities. That's a lot to look at. Let's see if we can just make some slight minor adjustments to start to knock this down. So I'm going to go into set filters. And the first adjustment I'm going to do is days to expiration. Again, this is our theta. So the theory behind theta goes that 40 days out, theta starts to increase. And then inside of there, it starts to increase faster and faster. And then inside of 20 days, it accelerates exponentially. So again, depending on our time horizon, we probably want to look at a shorter timeline. So let me just lower this down to where theta really increases to 20. Now the other well, before I go there, let me talk about this again. You know, a lot of my options sessions, we talk about the difference between monthly and weekly options and how I like to take trade in the monthlies because there's more open interest and a little bit more liquidity. But again, if we're trading a butterfly that's only has maybe 10 days or 3 days to expiration, then weeklies are fine. in this example, but we'll have both weeklies and expirations. I do tend to pick monthlies over weeklies. And the other minor adjustment I'm going to make to my screener right at this point is our moneyness to our leg 2, our body, right? We want to be net neutral, right? We want to be right as close as possible. So here we see our range is 5% outside of at the money. That's a little wide. What we might want to do is lower this. Now, on any given day, most markets move between, let's say, 0.5% and 1.5%. So let's just knock this down a little bit to, let's say, 2%. And if you wanted to make this 1% or 0.5%, that's fine as well. All right, so I just made 2 minor adjustments, and we had over about 1,000 candidates before. Let's see what this knocks it down to. All right, so we've knocked it down by 2/3. All right, so what other things can we do to add to our screener to help us find that better butterfly bush? So over here, I'm going to show you a couple different filters. But first of all, as I go through this process and I show you these different filter names, just realize that at any point you can type in a filter name or something that you want to filter, and it should pop up inside of this little box. Or you can go in here under the headers, and there's a lot of different categories of different elements that we can look for in terms of our options strategies, not only based on options, but also based on technical analysis of our underlying security, okay? So what I've done is I've created a screener for this session, and we do have tutorials how to create a screener. And the screener that I created, I just called it the butterfly bush. And so let's look at a couple of the things that I've added to our butterfly bush. Well, the first one is that max profit. We already had that as part of our defaults, but what we're going to do here is we're going to refine our defaults. Remember what I said, a 100% max profit is really telling us that I'm risking a value that is the same as the reward that I'm going to achieve. In other words, a 1-to-1 risk to reward ratio. So I've picked 99%. So I want to see those that are above 1-to-1. My strike differential. Again, this is a preference based on individual traders. Now, I know a lot of options traders who use this setup will use a $1 spread because their risk is going to be really, really small. But that small risk also means small returns. And also the tighter the range that we use increases the probability that price will be outside of our wings. So I've just choose $5, right? Kind of look for ones that are a little bit wider than that, but $5 to get us started. All right, our next 4 implied 1 month implied volatility, rank, percentage, and 20-day historical volatility are going to be more comparative filters for us. Again, in my process, what I want to look for is higher implied volatilities versus my historical. Now, it's in hopes, right, how I design the trade. If I'm right, then implied volatility will fall or return to the historical volatility. And that value, that value placement, again, depends on the individual trader, their preference, right? So if you wanted to look for only really super high volatility markets, then you would use a larger number. If you wanted to look for a conservative implied volatility, but maybe a higher rank, you could do that. All I want to try to achieve here is I just want to make sure that my implied volatility is greater than my historical. So that's why I chose 21 versus 20. All right, we're going to add something called the 20-day ATR, average true range. Now I'm going to show you how to use this in our chart analysis, so we'll come back to this a little bit later. Net delta. Again, I want to be net neutral. I want to be at that 0 point. So I'm going to make sure that I'm very close to net delta 0. So I could even make this tighter. I could make it 0.01 or 0.02. A nice little range here, about 0.05 would be a good starting point. Again, you could tweak this as you play with this butterfly strategy. Then again, we made those changes to our days to expiration, 20 days or less, and our moneyness. All right, so let's see what our screener does for us now. All right, so it's knocked it down to 55 different possible combinations. Now, at this point, what I can do is I can go to my flip charts. And if I click on flip charts, notice that our 55 different combinations really comes down to, what is that, about 10 different stocks. Again, at this point, I'm probably going to start doing that visualization, that technical analysis. I want to see price look like it's in a sideways trend, or that I see price has now either tested a recent high or low, or a swing high or low, and now is moving back into a range. For instance, here Apple does not look like that to me. It looks like it's just made a nice rally, and now it's backing off. So it looks like it's transitioning from an uptrend to maybe a potential downtrend. If I look at maybe AMD, let's see what that looks like. Okay, again, maybe a possibility that we've just made a swing low and that price could go back up. But in this case, I'd probably be more comfortable on AMD if price was, let's say, back inside of this range between 130 and 160, right? We're still on the lower end of that range. Now, here is a Federal Express, and here this is kind of what we're going to look for. Notice that I have drawn two boxes, a green and pink box, based on recent swing highs or swing lows or pivot highs and pivot lows. And now price is where? Right in between the two of them. Again, also notice that our boxes are equally distanced. So this is kind of what we want to look for visually. So let's do this. Let's take a look at a good example. This is a trade setup for Federal Express that was based on those minor adjustments made to our long butterfly screener described in the webinar. The values are from the closing range on Tuesday, December 14th, with our December monthly options that have 3 days to expiration. Those color boxes that I've pointed out to you are our areas of support and resistance based on significant swing or recent pivot highs and lows. Now notice these areas are equal distance from our current price, 230 to 240 and 250 to 240. The bull call spread consists of the long call strike 230, which is going to cost us $14.10, and a short call strike 240, which will allow us to collect $7.85. The bear call spread consists of the short call strike 240, which we're going to collect $7.85, and the long call strike of 250, which is going to cost us $4. If we put this together, the two longs are going to cost us $14.10 and $4, which is a total of $18.10. The two shorts are going to allow us to collect $7.85 times 2, or $15.70. So the maximum loss, or my net cost, is $2.40. Our maximum profit is going to be the wing differential, $10, minus our cost, $2.40. And so our maximum profit will be $7.60. This is exactly what we want to be looking for: a limited amount of risk versus a greater return. In this case, about 3 to 1. Our break-evens are represented by the red lines. Our wings, plus or minus, our debit, or our cost. So 230 strike plus the $2.40 cost inside of our wing, our break-even will be 232.40. Our 250 strike minus our cost, again, inside our wing, 247.60. As long as price remains between these two values, our butterfly will make a profit. Not the maximum profit, but somewhat less. Now notice I've added two other stats in the upper right-hand corner. Our 1 month implied volatility, 36.95, and our 20-day historic, 28.4. We want to choose those butterflies whose implied volatility is greater than the historical, in that belief that our butterfly, the price, is going to land on our middle strike. And thereby, the implied volatility will return to the historical and benefit our strategy. The third statistic is the 20-day average true range. Now, average true range is a measurement of volatility. It's based on 2 standard deviations. So 95% of all price action will fall inside of 2 standard deviations. So the 5.40 tells us there's a 95% chance price will remain inside of a range of $5.40. Now notice that that value, $5.40, is inside of our wing differential of $10. That's a good thing, right? Over the next 3 days, if price doesn't have a 2 standard deviation event, our trade will be profitable. But notice that that $5.40 is also inside of our break even as well. Another good thing to look for. But let's flip this around. Let's pretend that our average true range is 10 and our wing differential was 5. Then there would be a greater probability the price would move outside of our wings. So we want to find those trades where our average true range are inside of our differential. Now that could be a value that is close to or equal to, but we still would like to find it inside. In this case, it's about half of our differential. This is a good example of a potentially profitable long butterfly. Okay, so where are we at? Oh, we're doing just fine. Gene, I see you sent me a couple of questions here. So let me pause here and see if I can answer a couple of these before we go into some variations here.
And while you do that, John, I'm going to just mention to everybody that the screener that John is going through today is part of a Premier membership. So you will need a bar chart Premier membership to play around with the screener and to see what kind of candidates that you can get out of it by manipulating the filters. And if you're not a Premier member, we offer a free 30-day trial. John's going to talk about that toward the end of the session, but just wanted to throw that out there now. Okay, back to you, John.
Thanks, Gene. Thanks. So a couple questions here. I do see one from Massey, and the question was about filters for options. Shouldn't the max return be a value, it's times 100. I think I mentioned that, right? It doesn't matter what max return we want. We just really kind of want to look for that value of how much I'm going to risk versus my max reward, right? Again, depending on probability, I could end up risking more. Let's say I have a $5 differential and I risk, let's say, $3. Well, then my profit potential is only $2, right? So that would be a lower percentage, but there's probably a higher probability that that trade might work. So again, it's really about risk reward and risk tolerance. So again, the threshold that we kind of want to look at is at 100%, really one-to-one risk to reward. Aaron asks a question, can you share your thoughts about theta in long butterflies? I think I answered that theta, Aaron, that theta starts to increase inside of about 40 days, and then it really starts to accelerate in 20 days. So this type of strategy, options strategy, is for a little bit more advanced options trader. And again, there's a give and take here. If I'm setting this up at outside, let's say 30 days or 40 days, that's a lot more time price can move outside of my wings. Also, who am I selling the options to? They might be willing to pay more for that opportunity. So you might see higher premiums the more time we give the trade. As time decays, as we get inside 20 days, well, we're not going to see the same premium values because there's less time for price to move. So somebody who's buying those calls might not want to pay as much. So we might see lower premiums. Again, a give and take. But in the example I just did with the Federal Express, right, only 3 days to go, and we're still looking at a 3-to-1 risk-reward ratio. So DE says, hey, Federal Express earnings are this week. And yeah, that is something that we need to be aware of. Matter of fact, it's Thursday after the close. So again, depending on the trader, you might embrace earnings that increase probability, and then we look for the post-earnings volatility crush, what typically happens afterwards, right? Now, somebody might say, well, the earnings could be a big surprise, and you could have the market could jump a big percentage from where it currently is. And yes, it could. But remember, this trade is a limited risk trade. And if I'm comfortable of that risk of $2.40 versus a potential profit of $7.60, then that's a trade I'm going to set up. I'm going to set my trade, plan my trade, and trade my plan. All right? So let me look at a couple more questions here before we can move on. So Zach asks, what are the most profitable stock prices of this trade, say, in a few days? I'm guessing you're asking about the Federal Express trade. Again, I want to look for a wider strike differential, right? A little bit more opportunity to gain a little bit higher reward. Oh, here's one from Tim. Great question, Tim. Is there any way to adjust these types of strategies for non-margin accounts? So that's a good question. In terms of adjusting, this particular trade, we could talk about some types of adjustments. And again, so I don't want to get into the margin, not margin, or cash accounts. But because this is a limited risk trade, and there's really little we can do to adjust this trade in terms of what could happen. Any adjustments that we're going to make to this, for instance, if price moves to one of our extreme wings, would mostly come at an additional cost. It also might increase my risk. It might also lower my profit potential and also narrow that break even. So as far as making any physical adjustments to this trade, I'm going to leave this trade as is. I'm going to plan a trade and trade that plan. So D says, hey, the expected straddle move on this at the money is 16 points in either directions. Yeah, that's a good trick to learn. If you know what you're talking about there, D, that's great. That's the probability, right? But again, we also have to look at what is the probability of this stock moving on a day-to-day basis. Think about it. If I have a 5 ATR and I have a 3-day ATR movement, that would be around $16, right? $5 plus $5 plus $5 would be $16. That's, again, the same thing. Okay. One other additional strategy we can talk about is something called a broken wing. Now, I have a little bit of time constraint here, but a broken wing strategy is very similar to our long strategy. But what we're going to do is we're going to sell 2 slightly out of the money calls. And we'll still buy that one in the money call and buy that one out of the money call. A little bit different from our long butterfly. The long call that we're going to buy that's above the market will be at least 1 strike higher than we would normally set this trade. So for instance, let's say we're talking about stock XYZ and it's trading $49. I'm going to sell 2 $50 calls and I'm going to buy 1 $45 call. Normally I would buy a $55 call, equally distanced, but what I'm going to do is I'm going to buy a call that is at a higher strike, 56, 57, 58, 59, or whatever. Maybe I'll buy a $60 call. Now, buying that higher call, it's going to be cheaper, and that's going to allow me to collect more premium. So a broken wing strategy does have some benefits to it. The stock price could fall, and we still could make some money, right? I might even be able to put this trade on for a very small amount of risk, maybe even no risk at all, or maybe even a small credit. So our profit loss profile, when we look at this trade, would be that the downside, if price goes to the downside, would be a very small loss or maybe even a very small credit. At the money, I'm going to get my maximum profit. But on the upside, I'm going to incur a little bit of greater loss, but that would be limited to the upper wing differential, plus or minus either that net credit or that net debit. Okay. One more question. K. Smith says, is theta deducted on a daily basis? Yeah, theta is the change in price of decay from day to day. Okay. So do we have any other questions here? I don't see any, Gene, right? All right. So let me do this. Let me give you some takeaways. And I'm going to end a little early today so you folks can get out and for the Fed announcement coming on at 2 o'clock. So what are some of our takeaways? Well, first of all, we want to look for those candidates that could fall in conjunction with a quick time decay. Again, depending on the type of trader you are, depending on your risk tolerance, right? If you have you have risk tolerance, then you could take on the earnings, pre-earnings. But you could also wait until after their earnings, right? Now, in the example of FedEx, you only have 1 day, but let's say we had an earnings event in FedEx today. Maybe you could look at next week's options or maybe next month's options, right? The premiums might be as large or the volatility might be as large, but you still could get that volatility crush. If I'm looking at, for instance, ETFs, for instance, those major ETFs, the SPYs and the Qs, right? You could use the same kind of idea of decreased volatility after a event, for instance, the Fed, right? You wait for the Fed to pump up the volatility in terms of the FMOC, and then look for that volatility crush afterwards for some of the larger ETFs that represents our broader markets. Want to look at comparing our implied volatility to our percentile and our historical rank and percentile and our historical volatility. Again, we want to find higher implied volatilities. Higher implied volatilities, greater premiums. Greater premiums increases the probability, the risk-reward ratio, right? Looking for that relationship. We're going to use technical analysis, for instance, in supply and resistance zones, as well as average true range. So let's go back to that when we talked about average true range. So again, notice that here on this chart, right, that average true range is inside of those support and resistance levels. That is kind of what we want to look for. Again, if I can find an average true range that's inside of my strike differentials, that's going to be a good thing. But we also could talk about other technical analysis, stochastics and RSIs. Remember, we want to look for those where they're in a neutral position. In other words, around 50. Again, moving towards 50, either from below or from above. And then finally, remember that maximum profit can only be achieved if your butterfly lands directly on your body's strike price at expiration. So remember my daughters, right? How hard it was for them to predict where and catch butterflies, right? If our butterfly lands on our body's strike and I'm up 50% or greater with only a couple days left, right? I don't want to be greedy. I'm going to ring the register and take that profit and run. Okay, I hope you enjoyed today's session. I hope you got something out of it. I just want to remind you all that you can sign up for a free membership. As Gene mentioned, we have a basic membership that'll allow you access to most of the stuff on the website, but in order to get the option screener, as Gene pointed out, you need the premium membership. But one of the nice cool things is you can try this out for 30 days. And I know the other thing Gene is going to ask me to do.
Right, we're going to talk about next week.
Excuse me, I apologize for coughing there. All right, so coming up next week, we're going to do a year-end review of the dogs of the Dow. In the beginning of last year, or excuse me, in the beginning of this year, we looked at a strategy based on value trading and looking at 10 of the Dow stocks that were at the bottom of the barrel that had good dividends yields. And we were anticipating that throughout this year, those stocks would outperform the Dow in general. And so what we're going to do is we're going to go back and we're going to look at the trends that we were thinking about that could occur from last year to this year, which one of those trends played out, which one of the stocks benefited from those trends, and which one of those stocks did not perform well. We'll do a little bit of a relative strength analysis, and we'll look at the performance of these trends. So come back and let's have fun. We'll look at that, and I think that'll be really an exciting webinar. What else did I forget, Gene? Is that it? I think
that's it. Time to wrap up the session and
get ready for the Fed, right?
That's right.
Okay, well, listen, everybody. Again, if you enjoyed this session, I really appreciate it. I really appreciate all you being here, especially making time to be here. I want to thank you all. Be safe out there, the best of health, and the good of all trading.